Lesson 9, Sideways Movement, Consolidation, and Fundamental Announcements. Before we get started, I'd like to point out a couple things. In the bottom center, you will see a number. That is the number of slide that I will be on during this presentation. That number matches up the number in your workbook. If by chance you end up getting lost, all you have to do is look at the number in your workbook and the number on the slide, match the two up, and then you should be caught up. The other thing I'd like to point out is up in the top left-hand corner, there is a sign called Important Information. I have posted that sign on what I consider to be very important information on certain slides during this presentation. You may want to earmark those pages and go back and really study and perhaps even memorize the contents on that page. It will help you tremendously in your trading. There are 16 lessons on trading the Forex to help you. These lessons are also applicable in other markets because they focus in on technical analysis. Successful traders will do what unsuccessful traders can't and won't do. I commend you on taking the time to educate yourself on how to trade before you trade. Successful people have a tendency to properly educate themselves before they get involved with anything. Successful people are very different than unsuccessful people. Successful people have created a habit of being successful, just as unsuccessful people many times create a habit of being unsuccessful. Do not underestimate this statement, and if you will, try to apply this statement to many aspects of your life, stating successful people will do what unsuccessful people can't and won't do. When you're challenged with making a decision, ask yourself, what decision would a successful person make? When it's time to place a trade, ask yourself this, what decision would a successful trader make? The 21-day 3% rule states this, the human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information. If you play this lesson once and just shelve it, chances are, after about 21 days, you will only retain 3% of all the information from this lesson. If you study to become a trader, but then you go into the market and you start trading, but you have shelved all the information you have been taught for more than a month, chances are you will be operating at only 3% of the necessary information that you need to be a successful trader. Market Traders Institute and Forex.com want you to start trading maintaining 85 to 95% recall. Because of this, I admonish you to please play these lessons over and over again to where it'll help improve your percentages as a trader. By the end of this lesson, you will learn to find consolidation and recognize sideways movement. You will learn where to look for a fundamental announcement on the currencies. You will learn how to straddle consolidation, and you will learn what the term straddle means. You will learn how to avoid bull traps and bear traps. You will learn to place a straddle trade 15 minutes prior to the fundamental announcement. You will learn how to create a straddle trading plan and trade that plan. And you will learn where to place your protective stop loss orders and financially protect yourself in every trade. Before we get started, I'd like to do a quick review on the trading charts and placing orders. We are watching Japanese candlesticks. You can watch a line chart. You can watch a bar chart. I find Japanese candlesticks to be a little more user-friendly. They are applicable on all time periods. They monitor the open, the high, the low, and the close of any time period. there are bullish and bearish candlesticks. Bullish candlesticks close higher than they open, meaning the market is going up or rallying, and bearish candlesticks close lower than they open, meaning the market is dipping or reacting, falling. And the lines on each end are called wicks. They monitor the high or low of that time period. Let's look at this chart. See how when the market rallies, you have white bullish candles, and when the market dips and falls, you have black candles. You can also see that they have lines on each end. Those represent the high and low of that time period. Other important information, here's that sign, is that we watch bid charts. Most traders watch bid charts. There is a bid and an ask price at all times when it comes to trading. The ask price is usually higher. In the currencies, there is a 3 to perhaps 10 pip spread between the bid and the ask. This chart, or the charts that we are looking at, are going to monitor the bid price. The ask price will look identical to the bid price, except that it will be 3 to 10 pips higher. As you trade, remember you buy on the ask and you sell on the bid. What does that mean? That means if you enter the market buying and you enter an order at the market, you have bought on the ask, which means if the current price is 107.30, that's the bid. The ask price would be 107.35, which means if you entered at the market, you were filled at 107.35. That's the number you were filled at if there's a 5 pip spread. Now, if you place your stop orders for protection down here, every buy needs 2 sells. Your protective sell stop will be on the bid, which means all the candle has to do is hit that and you will be filled because we sell on the bid. Conversely, if you place a limit order for profit, the bid price, which is the actual movement of these candles, will need to come up and hit that order. The ask price will hit it first, the bid price will hit it second. Conversely, if our entry is a sell, we sell on the bid, which means if I short the market right now and sell, I will be filled at 107.30, but I will be placing my protective buy stop on the ask, which means as this chart rallies up, the ask price will hit my stop order first, and I will be filled on the ask. Many traders get confused. They say, well, gee, the candles never hit it. And because the candles never hit it, my order should not have been filled. No, we are monitoring the bid price. And our buy stop is on the ask because we buy on the stop. Conversely, the bid chart, if we were selling, or excuse me, because we shorted the market, we placed our buy limit because we're buying on the ask. The candlestick would have to come through our order in order for us to be filled because the ask is always a higher price than the bid. Types of orders. Lesson 1 focuses in on the types of orders that we'll be using in detail, but we use a market order, a limit order, and a stop order. These are the predominant orders we use when trading currencies. Whenever we buy above the market, that is called a stop order. When we sell above the market, that's a limit order. When we buy below the market, that's a limit order. And we sell below the market, that's also called a limit order. Any order placed, if this is the current market, any order placed above the market will be called an open, working, unfilled order. Depending on whether you are buying or selling will determine whether it is a limit order or a stop order. If the order is a sell order up here, then it is a limit order. If it's a buy order, it is a stop order. Buy stop, buy limit. Your buy limit when you buy below the market, that is called a limit order. When you sell below the market, that is called a stop order. Any order placed below the market is called an open, working, unfilled order. Therefore, if you place a buy order below the market, that's a buy limit. If you place a sell order below the market, that's called a sell stop. Please understand this to avoid confusion as your orders are filled. Ordering rules, just quickly, important information. Whenever you buy, you should have two sells, one for profit, one for loss. Even if you are canceling and replacing, you may want to place a sell order way up there, kind of like a wish list. Boy, if the market rallies and goes 300 pips, even though I'm going to cancel, replace, and lock in profit along the way, if it hits that order, I'd be very satisfied. Every buy should have two sells. Here you go. Market breaks a trend line, enters into the buy zone, which is less than 6. Our buy entry has two sells. It has a sell stop loss order and a sell limit order for profit. Conversely, whenever we place a sell, we need two buys. When we sell, our position is short. We are bears. We want the market to dip, come down. We buy then at a lower price for profit. We sell at we buy at a higher price for loss. Every sell should have two buys. Let's look at this sell. This sell entry has a buy stop loss order at the last high and a buy limit order for profit. Every sell should have two buys. OCO, the term OCO means whenever you enter the market, whenever you place your limit or your stop order or both, you attach them to your entry order, and if the market hits your limit order first, it'll cancel your stop order. If it hits your stop order first, it'll cancel your limit order. One cancels the other. When canceling and replacing, please keep in mind, only cancel or replace to the new last low after the market has made a new high. Meaning if this is your entry and the market's rallying, see how it retraces back? After it rallies one more time and makes a new high, now that we've made a new high, you can bring your stop order from the last low to now the new low. Now that the market rallies, makes a new high, retraces back, bounces at perhaps a Fibonacci number, a trend line number. As it rallies, making a new high, you see how it's taking out the old high, making a new high. As it is establishing a new high, you now can cancel, replace your order from the last low to now the new last low, which will be support. The exact same process takes place, only cancel and place to the new last high after the market has made a new low as you sell the market. Bulls buy low first and sell high second. Doesn't matter what your methodology is. If you buy first, you are telling the world you are a bull and you will need to sell at a higher price to make a profit. Look at how this indicator provided 1, 2, 3 sells, which equated to 290 pips. At $10 a pip, that's $2,900 times, if you were to trade 10 lots, that would be $29,000. Bears want to sell first and buy second. Whenever you enter the market selling first, you are telling the world you want the market to turn bearish, you want the market to dip, you want the market to go down. You are involved in a hopeful bearish move. As the market starts to fall, you will come out buying second, therefore you will have bought low and sold high. Look at how we sold first, bought second, but we bought low and sold high. If you buy something at $104 and sell it for $107, did you make any money? Yes, you made $3. Look at how these two moves generated 350 pips. Many times you'll notice that the market falls faster than it rallies. And one of the reasons why the market falls faster than it rallies is because fear is a greater emotion than greed. And whenever you find a product, a stock, a currency, whatever, as it devalues faster than it increases in value. That's why many times the devaluation of anything happens at a much more rapid rate than the increase in value. Keep that in mind. Technical traders learn to read charts. See, technical traders read charts like doctors read x-rays. Why? Because to the trained eye, these charts are telling a story. And the story they're telling is where the next probable move is going to be. Traders make money on forecasting the future, not so much on looking at the past. It's hard to make money saying, well, I should have got in here, should have got out there. We all can make lots of money doing that. We have to make a decision on where the market's going to go in the future. Because a chart is a chart is a chart, technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you've been educated on how to read a chart, you will control or start to control your financial future in any market. A quick review on support and resistance will be very helpful for this lesson. Remember, we need to spot highs and latest levels of resistance and support. So a high is 2 candles to the left that are lower than the wick high and 2 candles to the right that are lower than the wick high. That'll constitute a high. However, not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently trading. Let's look at a low. A low has 2 candles to the left that are higher than the center wick and 2 candles to the right that are higher than the center wick. That makes a low. Not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Lesson 2 really focuses in on this. If you have trouble with support and resistance, please review Lesson 2. But let's look at this. Your latest highs and your higher highs become your levels of resistance, and your latest lows and your lower lows become your levels of support. Do not underestimate the game between the bulls and the bears, as I focus in on that in Lesson 2. Understand that. It can help you tremendously in profit taking. A quick review on trends and trend lines will also be helpful for this lesson. Remember, there are swings inside of swings, which is Lesson 7, but the market is constantly on the move, going sideways, if not rallying, reacting, but they are creating little swings, highs and lows, highs and lows, highs and lows. But they also create one big swing. As I focus in on this on Lesson 7, it can become very helpful. Look at this chart. Low to high is an upswing, high to a low is a downswing. Low to high is an upswing, high to low is a downswing. Look at how the market moves in swings. But not only does it move in swings, little swings, it creates one big upswing. Now, uptrends are nothing more than swings that are making higher highs and higher lows. Let's look at this chart. Market is making higher highs, 2 to the left, 2 to the right. This high is higher than that high, this high is higher than that high, and higher lows. This low, 2 to the left, 2 to the right, is higher than that low, and this low is higher than that low. That is an uptrend. Higher highs and higher lows. When you spot an uptrend, you will draw your trend lines across the lows of support. Lesson 5 really focuses in on trend line trading. Look at how we drew the trend line in an uptrend across the lows of support. Now, there are three primary upward trend lines. There's an inner, outer, and a long term. Downtrends work the same way, but in the opposite directions. Downtrends create lower lows and lower highs. Look at how the market is making lower lows and lower highs. Whenever the market's making lower lows and lower highs, it is a downtrend. If you spot a downtrend, you will draw your trend line across the highs of resistance. Look at how we draw them across the highs of resistance. Once again, Lesson 5 really focuses in on teaching you how to draw your inner, outer, and long-term trend line, and because the market is constantly trending if it's not going sideways. Look at how it's slowly trending up, then aggressively trends up, then slows down, then reverses, forms a crown, which is Lesson 8. and then starts to fall, and then crowns again and turns around and rallies again. Look at how it downtrended, uptrended. Lesson 5 really focuses in on that. Let's look at this chart. Rallies up, reacts, rallies up, makes a huge swing inside a bunch of small swings, and a large uptrend inside an uptrend, downtrend, and an uptrend. Lesson 9, sideways movement, consolidation, and fundamental announcements. Now I find this lesson to be a fun lesson. Understanding how consolidation works can really become profitable to the trader. The best way to understand what you've learned is to write down what you think you know about consolidation, and then go back after you've been taught and look at what you thought you knew versus what you now know. Your perception is your reality. My perception is my reality. These lessons are about transferring my perception of how the market works to your perception of how the market works, and creating an accurate perception of how the market works to where you can take advantage of price movement in the market. Write down what you think you know about consolidation, sideways movement, bracketing. Pause your machine. This is an Euro 1 hour chart. Consolidation works on all time periods. This is a Euro-Yen cross. This is a 4-hour chart. Find consolidation, bracketing, sideways movement on this chart. Pause your machine. This is a Euro 15-minute chart. Find consolidation, bracketing, sideways movement on this chart. Pause your machine. This is a Euro-Yen cross, 4-hour chart. Find consolidation, bracketing, or sideways movement on this chart. Pause your machine. This is a British pound 30-minute chart. Pause your machine. Okay, the market is constantly on the move. The Forex is constantly on the move. It is going up, down, or sideways. Constantly. Let's look at it. Sometimes it's going real slow, calms down, and then all of a sudden it starts to turn real aggressive. Look at this chart. You will learn about pennants, and pennants. This is what's called a diamond pennant. You'll learn about that in our lesson on pennants. It's very, very informative, and trading pennants is very, very productive as well. Pennants can be found in lesson 15, trading pennants. But the definition of accumulation, consolidation, bracketing, or sideways movement is this: when prices establish a tight trading range, creating somewhat equal levels of support and resistance. Now let's look at this. This is accumulation, consolidation, bracketing, sideways